In this episode, we're going to cover the updates to the 7A loan program, and to do that, we've asked Jessica Beck, VP with Wells Fargo, to join us to discuss those topics, which include a partial buyout, streamlined refinancing, and reduced loan guarantee fees. So if you're a buyer or an owner, stick around because you're going to find this episode fairly helpful. Jessica, welcome to the channel again.
Thanks for having me. Nice to be in person this go around.
So those of you who haven't seen the other episode that Jessica and I did, we had a little technical issues with the cameras, so being remote. So we decided to do this update in person. So thanks for coming out. And there's been an SOP that was put out, or a change to the regs for the 7A program last summer. And it was a little confusing, and I know that your folks at Wells Fargo and I think a lot of the other lenders kind of lobbied and went back to Congress to get some clarification on a few issues. So with that, we finally have gotten those done, and those were issued about 60 days ago, clarifications, correct?
Might have even been sooner than that.
Oh, is that right?
Yeah.
Okay.
So yeah.
So the big news with the latest updates is partial buyouts.
Yes, since the SBA has been around, I think since 1953, if I'm not mistaken, they've never allowed for partial buyouts. So this is new for everyone that they're going to allow for that. Okay, so why don't you go through some of the criteria for the partial buyouts? Yeah, so basically the way the standard operating procedures were written, it appears we're going to be mirroring basically what we used to allow for partner buyouts. The rules are very similar. If you own 20% or more,
right,
the individuals are going to have to personally guarantee. Depending on the strength of your balance sheet, you may or may not have to have a down payment associated with that.
Yeah, so those two things I think are big. So if you think about this a little more, if you have a partner in the company that owns 19% or less, they're probably not going to have to personally guarantee the SBA loan.
Right.
Right. The capital injection or equity injection of the 10% for a partnership buyout or for a partial buy-in is really on the balance sheet, the basis of the balance sheet. And 9 times out of 10, you're probably going to need that 10% unless the balance sheet is really strong.
Right, exactly. It has to be a really strong business, typically.
The other thing about partial buyouts is you're still requiring, so SBA's always been kind of I'll use my real estate vernacular, an owner-occupied type of situation where you're going to be operating the business. And so if you have a partner, if you're selling 30% of the business and you're bringing a new partner in, that partner is going to need to work in the business.
Correct. That's always been the rule with SBA. Whoever's borrowing the money needs to be there day to day.
Yeah, day to day.
Can't be just an investor.
But that leads to the underwriting question of how do you qualify that person? And how do you qualify the debt service coverage ratio that needs to be run? I mean, how do you calculate that?
Yeah, so it's just like when you're buying a business. I mean, every situation is going to be different.
Right.
So we'd have to look at the individual's resume, their industry experience, what business we're buying, because every business is so different from the next.
Right.
So it's just going to depend on that situation. Because obviously, if it's a law firm, for example, obviously you should be a lawyer if you're buying in, and have those industry experience. Like it's got to make sense. But obviously, if it's like a simple retail business where you may not have direct experience, but you can argue transferable. So each situation's different.
So I think the other thing for the seller, this is a way to sell the majority of your company, say 80%, and for you to continue to work, because that's in the business and stay involved in the business. So a lot of times in the past where you've had complete transfer of the business, the seller can only stay there for up to 12 months, and then they've got to be exiting the business.
Right.
So that's always been kind of one of those things. So this gives you some more flexibility, more tools in the toolbox.
More options and for different scenarios.
Yeah, perfect. So the other change to the SOPs was really around the equity injection. Now, this is one I always have to caution when you get to SBA guidelines, that every lender does it differently, and a lot of credit departments will put a credit overlay on some of the things that you might kind of scratch your head about. But SBA, for loans less than 500, technically they don't require a down payment, an equity injection.
Yeah, they no longer require it. And those loans are considered, they're called SLA for small lending advantage, just so you guys know. So those are the ones that get the SBA score technically. They have a scoring system within the SBA. So they increased it too to that 500,000 mark as well.
Oh, is that right? It was 250 or 350?
Close, 350.
Yeah,
it was 350.
Okay.
Yep.
So for loans greater than 500,000, the 10% equity infusion still stands.
Correct.
Okay.
They just decided to loosen the guidelines on this, on what they consider smaller, which is the 500.
Yeah. And then the seller note, if it's put on complete standby for the term of the note. Now, this is the old rules. The old rules were if you had a 10-year term and the seller in the transaction had a seller note and they deferred all payments for 10 years for the term of the note or until SBA was paid off, most lenders would take a look at that as a down payment. So the buyer had literally zero equity injection, in the transaction. But again, gets a few extra looks by the underwriter to make sure that it makes sense and there's circumstantial evidence to warrant that, correct?
Right, yeah. Every situation's different.
Yeah. So here's the new one, and this one was when I was reading the SOPs and Jessica and I were talking, I'm like, really? This doesn't quite make sense, but here's the new rule. And the rule is that if the seller puts the seller note for 10% on standby for 24 months, SBA will require that as their 10% equity injection. So in both cases, I'm assuming that even though there's an equity injection of the seller note, that term of that seller note, even though they're put on standby, is going to be used in the qualification of the buyer and the cash flows of the business, correct?
Yeah, so the business just needs to be stronger if you're trying to do 100% financing.
Now, I've done one in 5 years, the last 5 years. How many have you seen at all?
I have certainly had seller carry notes, but I've always had a borrower have injection.
Yeah. I haven't seen too many sellers that actually wanted to. Now, the 2-year or 24-month is a new wrinkle, so you might see more of that come through. But I've seen very few sellers want to not get paid for their business for 10 years.
Correct.
Okay.
Yeah, most sellers want the money.
Yeah. And again, this is one of those ones, if you've got a transaction, talk to your SBA lender, because each lender may have a credit overlay that's a little different.
Correct. Most definitely.
Good. Personal resource test. The rule's been changed, so could you give us some history on what it used to be and what it is now, and maybe how it affects the buyer pool?
Yeah, so they added what's called a personal resource test maybe 4 or 5 years ago. I don't know exactly, but that was added trying to say if someone has enough cash themselves to purchase a business, they shouldn't be obtaining an SBA loan to do it. And so it was up to each lender to define to themselves, because there was never really a set rule in place as to the test, but basically they just couldn't have enough cash. But now that rule's gone.
But this allows a larger pool of buyers. So buyers who have, 401ks or, that may be $1 million or $2 million can buy $1 million business and get it financed through SBA.
Right. It just allows for a stronger buyer pool. I mean, the business still needs to be a small business, as defined by the SBA. But yes, you can have a lot more cash than in the past couple of years.
Right. So one of the other changes has been the elimination of life insurance policy. And a life insurance policy was always required for not the entire loan, but usually to cover any gaps between, say, the assets that are out there and the valuation of the business. So if you had a business that was you're purchasing it's $2 million and you had $1 million worth of assets, usually there's a requirement for probably that $1 million, the what we call an airball in the business, that differential to secure the business. That's no longer required, and I was a little surprised when I saw that.
Yeah, so I definitely check with your lender because each lender is going to have their own
Right.
interpretations now. But yeah, technically speaking, now the SBA is not requiring. So they used to not require it for the smaller transactions, the SLA, but now they've extended it to all loan sizes.
Yeah, so Jessica and I were talking off camera. It's a really good idea, and I would strongly suggest that if you're buying a business that, and especially if it's a larger business, if it's a million to a 2 million or a $3 million business, and you're taking a $2 million loan against that to get key man life insurance policy against that, in the event of your passing, especially if you have business partners, it's going to put a severe strain on the business to continue to pay that loan off over a period of time, because just because you left doesn't mean the bank's not going to want repayment somehow.
You're right. I mean, I have that conversation a lot with borrowers as well. Even when we're doing real estate loans where we're quote secured and we're not requiring it, it's always a good idea to
Right.
have insurance to
Yeah.
protect yourself for
And-
unexpected life events.
And the larger the business, the more important it actually becomes.
Right, exactly. And it's usually really, and I mean, I'm not an insurance salesman by any stretch of the mean, but
Yeah,
it's
well,
usually
it depends
pretty
on your
inexpensive.
age, right? So a
That's
little
true,
more
too.
for me than you. Refinancing debt. So this SOP made this easier, and it was titled Streamlined. And as I read through the SOP, I was a little puzzled as to actually what changed. So off camera again, I was talking with Jessica, and she explained that prior to this, you couldn't refinance one SBA loan and use another SBA loan to refinance a debt, but that's changed.
Correct. Yeah. So now the SBA is allowing for it. So in the past, it was like the biggest faux pas because you were paying your guarantee fee twice. You would have to explain why. They'd have to go to that other bank and they'd have to refuse to refinance it or modify that loan before you were able to refinance it.
Yeah. So, we were also chatting that, in this interest rate environment, so variable rates for a 7A loan for a business right now are running about 11 to 11.5%, depending on the margin over prime. Wells has been portfolioing these loans for quite a while and offering a fixed rate alternative kind of in the mid eights to eight, maybe 8.75. So if you're been on a variable loan, say you purchased a business 3 years ago when interest rates on a variable were actually fairly cheap,
Right.
5.5%, but now all of a sudden you're almost double your interest rate. Being able to refinance to a fixed rate makes a lot of sense and could actually save you some capital, in the business. So, as always, I always leave Jessica's number and contact info. You may want to call her on this one. But so that's actually been streamlined. So any other debt that is allowed to be refinanced long-term, and this is just long-term debt,
Yeah,
it's not short-term debt.
Yeah, you can still do short-term debt. That was always allowed. You just had to
okay.
prove it was used for the business. And probably the big thing is that the rule's still in place that you have to save the borrower 10% in their monthly payments in order to refinance it.
Okay.
Or the loan has to have like a balloon payment or some sort of unreasonable term that the SBA wouldn't have. So if
Okay.
you've got like a real estate loan that's only for 5-year term and then it's going to balloon, that can be refinanced.
Okay. Loan guarantee fees. Prior to this SOP, loans where that were under $500,000 had zero for a guarantee fee. With this new SOP that came out, they've upped that.
Yeah, they want to encourage, I think, some small, what they consider, small loan size.
So they've upped that to, for loans less than $1 million or $1 million less, it's zero. So there is no guarantee fee, which in the past has been like 3.5%.
Right, and that's a one-time fee that goes to the government for utilizing the SBA program.
Yeah. So if you're at $1 million, 3.5, although it's $3,500, it's $3,500 that you don't have to do anymore. And then loans between $1 million and $2 million kind of have a stepped up rate for loan guarantees, and I believe it's 1.45 for the first million and 1.75 for the second million, correct?
Right, exactly. And those fees are financed within the loan.
Okay. And then for loans over 2 million, it's the same as it's always been. It's
business as usual.
Yeah, it's about between 3.5% to 3.75%. Again, that's financed in the business, but it's interesting. This is the zero guarantee fee for less than $1 million. I've been doing this for 12, 14 years now. That's a good deal.
Oh, yeah.
For borrowers.
Oh, most definitely. So yeah, I've had borrowers come in with a little extra cash, keep their loan, under $1 million, so that way they don't have a fee, which is great.
Okay, great. Well, Jessica, it's always a pleasure having you on the channel. And for those who don't know, I've done a couple deals in the past with Jessica and Wells. Always been pretty smooth. What I like about Jessica is what I said in the last video, is that she is incredibly knowledgeable, gets back to me incredibly fast, and is a problem solver, and that's what you want with a lender. So Jessica, thank you for coming over and spending some time in the office. This was a whole lot easier than trying to do it online.
Thank you so much.
You're welcome.